The stock market is confusing. Financial experts know this. So instead of explaining it properly, I'm going to explain it using sports metaphors. Most of them will not make sense. That's intentional. Neither does the stock market. What is a stock? Great question. Imagine a football team. Now imagine you can buy a very small piece of that football team. Not a player, not a jersey, not even a seat. Just the vague feeling that you are involved somehow. That's a stock. The team keeps playing whether you own a piece or not. They don't know you exist. They will never know you exist. But if they win, if the team does well, your piece becomes worth more. If they lose, it becomes worth less. If the quarterback gets injured, loses 3 games in a row, and tweets something weird at 2 a.m., your piece might be worth almost nothing. Now, what is the stock market itself? The stock market is like a stadium. Thousands of people screaming. Nobody agrees on anything. Hot dogs are $18. And somehow, at the end of the day, a number goes up or down and everyone acts like they saw it coming. Some people in this stadium are professional investors. They have spreadsheets, algorithms, and MBAs from schools you've heard of. They've studied the game their entire lives. The rest are retail investors. That's us. We show up with a Robinhood account, a podcast we half listen to on the treadmill, and a level of confidence that is, medically speaking, not proportional to our knowledge. Let's talk about bull markets and bear markets. A bull market is when prices are going up. It's called a bull market because bulls charge forward. Aggressively, with energy, everyone loves a bull market. People on financial Twitter post their returns. Your coworker who got into stocks 6 months ago will not stop talking. A bear market is when prices are going down. It's called a bear market because bears hibernate. They go quiet. They disappear. Much like your coworker who has suddenly stopped mentioning their portfolio entirely. What is diversification? Diversification is like fantasy football. You don't put all your faith in one player. You spread your picks across multiple teams, multiple positions, multiple players, so that when your star running back tears his ACL in week 2, which he will, you are not completely destroyed. In investing, you spread your money across multiple stocks, sectors, and asset types: tech, healthcare, energy, international markets. The idea is that when one area collapses, and one area will always collapse, the others hold you up. The fancy financial term for this is, don't put all your eggs in one basket. Economists spent decades developing this concept. They named it modern portfolio theory. They got a Nobel Prize. The eggs metaphor was free. What is market timing? Market timing is the practice of trying to buy stocks at the lowest possible price and sell them at the highest possible price. It sounds straightforward. It is not straightforward. It's like trying to predict exactly when a basketball player is going to have their best game, buying tickets specifically for that game, and then selling those tickets at peak price right before the buzzer. Except the player doesn't know when their best game is. The team doesn't know. The coach doesn't know. And the guy on Reddit who says he knows does not know. Research consistently shows that time in the market beats timing the market, meaning the investor who buys and holds for 30 years quietly outperforms the investor furiously checking their phone every 20 minutes, every time. It's deeply unsatisfying. It's also true. What is a market crash? A market crash is like a soccer match where, halfway through the second half, everyone in the stadium simultaneously decides the game isn't worth watching anymore, stands up, and leaves. Prices drop. Panic spreads. Someone on TV uses the word unprecedented. The important thing to understand about market crashes is that they always feel permanent, and they never are. Every single crash in history, 1929, 1987, 2000, 2008, 2020, eventually recovered. Everyone. The market has a 100% recovery rate from crashes so far. That's a better record than most sports franchises. So, to summarize, a stock is owning a piece of a team that doesn't know you exist. The market is a stadium where everyone is wrong but confident. Bull markets make your coworker unbearable. Bear markets make them disappear. Diversification is fantasy football with your retirement. Timing the market is impossible, and the boring strategy wins. And crashes are temporary, unlike some sports droughts I could mention. None of these metaphors were entirely accurate. All of them were more useful than reading a 300-page investing textbook. If you want more financial concepts explained with this level of rigor, subscribe. We post every day. The metaphors will get worse before they get better.